There is money sitting in your retirement account right now that you worked 40 years to build, and there is a very good chance that the way you are planning to use it, or the way someone is advising you to use it, is going to hand a significant portion of it straight to the IRS before you ever get the chance to spend it. Not because you did anything wrong, not because you broke any rules, but because retirement accounts come with a set of hidden traps buried inside the tax code that nobody explains to you when you open the account. Nobody explains when you retire, and nobody explains until the damage is already done. My name is Patricia Holloway. I'm a certified financial planner, and I've spent 19 years working exclusively with retirees and pre-retirees, navigating the transition from saving money to actually using it. And I will tell you plainly, the most expensive mistakes I see are never made by careless people. They are made by careful, responsible people who saved diligently their entire lives and then made one or two uninformed decisions at the exact moment those decisions mattered most. Today, I'm going to walk you through 5 of the most dangerous retirement account traps that are costing seniors thousands of dollars every single year. What each trap is, why it catches so many people, and exactly what to do to avoid it. Stay until the end because the 5th trap is the one that surprises people the most, and it is also the one that is completely invisible until it is too late. Trap number 1. Taking too much too soon. When people retire and see a large number sitting in their IRA or their 401k, the instinct is understandable. You want to enjoy it. You worked for it. You earned it. So you start pulling it out. Here is what most people do not realize until the bill arrives. Every dollar you pull out of a traditional IRA or a traditional 401k is counted as ordinary income in the year you take it. Not investment income, not capital gains, ordinary income. The same category as a paycheck. And if you pull out enough in a single year, you can push yourself into a higher tax bracket, trigger taxes on your Social Security benefits, increase your Medicare Part B premium, and create a tax bill that wipes out a significant portion of what you withdrew. This is called a distribution spike, and it catches people constantly. Here is a real example of how it works. A retired couple living comfortably on $45,000 a year between Social Security and a small pension decides to pull $80,000 from their IRA to pay off their mortgage. In that 1 year, their total income for tax purposes jumps to $125,000. That spike pushes them into a higher bracket, causes 85% of their Social Security to become taxable for that year, and triggers an IRMAA surcharge, which is an income-related Medicare premium adjustment that raises their Part B premiums for the following 2 years. The mortgage is paid off. The tax bill arrives. They did not see it coming because nobody told them the withdrawal would reach across and grab their Social Security and their Medicare at the same time. The action here is this. Before you take any large distribution from a retirement account, run the numbers with a tax professional or a fee-only financial planner, specifically to model the impact on your Social Security taxation, your Medicare premiums, and your overall bracket for that year. A distribution that feels like a windfall can turn into an expensive surprise if you do not see the full picture first. Trap number 2. Missing or mishandling required minimum distributions. Once you turn 73, the IRS stops letting you leave your money in a traditional retirement account indefinitely. They require you to take out a minimum amount every year based on your account balance and your life expectancy. This is called a required minimum distribution, or RMD. Miss it, and the penalty is one of the harshest in the entire tax code. Until recently, it was 50% of the amount you were supposed to take. Congress reduced it to 25%, and in some cases 10% if corrected quickly. But even at the reduced rate, that is a penalty that can run into thousands of dollars for missing a single year. Here is where people get caught. They have multiple retirement accounts, an old 401k from a previous employer, a rollover IRA, a current IRA, and they either forget about one of them or they assume the financial institution is tracking this for them automatically. Some institutions send reminders, many do not. The responsibility is entirely yours. There is also a second trap inside this one that almost nobody mentions. The RMD calculation uses the balance in your account from December 31st of the prior year. If your account dropped significantly during a market downturn that year, your RMD may be lower than it was the year before. But if your account grew substantially, your RMD will be higher, which means a larger taxable distribution, even if you did not want or need that much income. The action here is to make a complete list of every retirement account you own, including old employer plans you have not rolled over. Contact each institution and confirm whether an RMD applies and whether they have automatic distributions set up. Do not assume. Confirm in writing every year before December 31st. Trap number 3. The Roth conversion mistake. In recent years, Roth conversions have become one of the most popular pieces of advice in the retirement planning world. Convert your traditional IRA to a Roth, pay the taxes now, and then enjoy tax-free growth forever. It sounds simple. For some people, it is the right move. For many others, it creates a problem nobody anticipated. Here is the trap. When you convert money from a traditional IRA to a Roth IRA, the entire converted amount is counted as ordinary income in that year. The same distribution spike problem from trap number 1 applies here, except this time you may be doing it intentionally without fully understanding the cascade of consequences. A conversion of $50,000 in a single year can push your income high enough to trigger IRMA Medicare surcharges for the following 2 years, make a larger portion of your Social Security taxable, and push you into a bracket where the tax you pay on the conversion actually exceeds the long-term benefit of the tax-free growth. The people who benefit most from Roth conversions are generally people who convert in smaller amounts over several years during a period when their income is temporarily low, right after retirement but before Social Security and RMDs kick in. That window is often called the gap years, and it is one of the most valuable and underused planning opportunities in retirement. The action here is never to convert a large amount in a single year without first modeling the full tax impact, including Social Security taxation and Medicare premium effects. Smaller conversions spread over several years almost always produce a better outcome than one large conversion done quickly. Trap number 4. Naming the wrong beneficiary. This one does not cost you money during your lifetime. It costs your family an enormous amount the moment you are gone, and it is one of the most preventable mistakes in all of retirement planning. Your retirement account does not pass through your will. It passes directly to whoever is listed as the beneficiary on file with the financial institution. That designation overrides everything your will says. It overrides your intentions. It overrides family agreements. The name on that form is who gets the money. Full stop. Here is where the trap closes. People open a retirement account at 35, name their spouse as beneficiary, and never look at it again. They get divorced, they remarry, they have grandchildren. The beneficiary form still says the first spouse's name 30 years later. When they pass, the ex-spouse gets the retirement account, regardless of what anyone intended. There is also a secondary trap for the people who inherit these accounts. Since 2020, most non-spouse beneficiaries are required to withdraw the entire inherited retirement account within 10 years and pay income tax on every dollar as they take it out. If your adult child inherits a $500,000 IRA, they cannot spread that out over their lifetime anymore. They have 10 years. And if they are in their peak earning years during that window, the tax hit can be significant. The action here is one of the simplest on this entire list. Pull out the beneficiary designation form for every retirement account you own and review it today. Not this year, today. Confirm the names are current and intentional. Consider naming contingent beneficiaries in addition to primary ones. And if your estate is large enough to create a significant tax burden for your heirs, have a conversation with a financial planner about strategies to reduce that impact before it becomes your family's problem to solve. Trap number 5. Ignoring the sequence of withdrawals. This is the trap I promised you at the beginning, the one that is completely invisible until it is too late. And it is the one that surprises people the most because it sounds simple, until you see what it actually does. Most retirees have money in multiple places: a taxable brokerage account, a traditional IRA or 401k, maybe a Roth IRA, a pension, Social Security, and when they need money to live on, they pull from whichever account feels most convenient or whichever one their financial advisor set up automatic withdrawals from without ever stopping to ask whether the order matters. The order matters enormously. Withdrawing from the wrong accounts in the wrong sequence can cost you tens of thousands of dollars in unnecessary taxes over the course of a 20-year retirement. Here is the general principle. In most situations, you want to draw down taxable accounts first, then traditional retirement accounts, then Roth accounts last, because Roth money grows tax-free indefinitely, and the longer you leave it, the more powerful it becomes. But this general rule has exceptions depending on your bracket, your RMD schedule, your Social Security timing, and your estate goals. What I see constantly is people doing the exact opposite, drawing down their Roth first because it feels like free money, leaving the traditional IRA untouched and letting it grow, which sounds responsible, but actually makes the RMD problem worse every year, because the required minimum distribution grows as the account grows. By the time they are 78 or 80, they are being forced to take out more than they need every year and paying taxes on all of it. The action here is to sit down with a fee-only fiduciary financial planner, not someone paid on commission, and build out a withdrawal sequence strategy specifically for your accounts. This is a one-time planning exercise that can save more money over the course of your retirement than almost any other single decision you make. Let me bring this back to where we started. You spent 40 years building what is in those accounts. The rules around how you use it are complicated, they are buried in the tax code, and not one person whose job involves managing or collecting from those accounts is going to call you and explain them. Here is what I want you to do this week. Pull out the beneficiary designation forms for every retirement account you own and confirm they are current. Look up your RMD deadline if you are 73 or older and confirm it is being handled. And before you make any large withdrawal or conversion this year, get a second opinion from a fee-only planner on the tax impact. The money is yours. It has always been yours. These traps do not exist to steal it from you. They exist because the system was never designed to explain itself. And now that you know where to look, none of them have to catch you. If this video helped you, share it with one person over 60 who has a retirement account and has never had anyone sit down and explain these rules to them. That one share might be worth more than they will ever know.